Welcome to The Explainer. Today, we're doing something a little different. I want you to step right out of your everyday routine and step into the shoes of a CEO. Imagine you're sitting at the head of a massive boardroom table and you're staring down a multi-billion-dollar war chest. You have to make high-stakes decisions that are literally going to define the future of your company. They'll determine your stock price and, hey, maybe even disrupt entire industries. But here's the catch. Your resources are limited, and one wrong move, it could be absolutely disastrous.
So that brings us to the ultimate question. How do major corporations actually choose where to spend millions or, billions of dollars? Now, from the outside, it might seem like magic or maybe just the brilliant gut instinct of visionary leaders. But actually, there's a rigorous, highly structured process driving these choices. In this explainer, we're going to completely demystify the behind-the-scenes mechanics of capital allocation. We're giving you the exact playbook that executives use to deploy capital and create massive shareholder value.
Here's our roadmap for today. First, the playing field. Second, the game plan. Third, the scorecard. And finally, number 4, the fumbles.
Section 1. The playing field. Capital investments.
Okay, let's dive right into this. Before you can decide where to spend your money, you gotta know what your options are, right? In the corporate world, every single dollar spent on a long-term asset is considered a capital investment. And these basically fall into 2 broad buckets: maintaining the business and growing the business. Over on the left, maintain business includes going concern projects. Think replacing aging servers just to keep the lights on, and regulatory projects, like installing legally mandated pollution controls. These are low-risk necessities, you just have to do them. But on the right, grow business carries much higher risk and much higher reward. This covers the expansion of existing operations and launching entirely new lines of business. Let's see what this looks like in the real world. Think about Sony Interactive Entertainment. We all know they already absolutely dominate the gaming console market with the PlayStation, but to expand their scale and reach, they made a massive capital investment. They acquired Bungie, that's the studio behind Halo and Destiny, for a staggering $3.6 billion. There's no way this was about keeping the lights on. This was a highly calculated move to expand their footprint into live game services and reach billions of new players, all within an industry they already deeply understand. Now, on the completely opposite end of the growth spectrum, we have new lines of business. This means expanding way outside of a company's current wheelhouse, which obviously carries a much higher risk. Take Kirin, the massive Japanese beer and beverage producer. Back in 2019, they decided to allocate 129 billion yen to become a top shareholder in Fancl. That's a cosmetics and dietary supplement maker. Now, why on earth would a beer company buy into skincare and supplements? Well, to combine research and development capabilities and capture a completely new market. It's incredibly high risk, for sure, but it represents a really bold capital allocation decision aimed at unlocking entirely new revenue streams. Section 2, the game plan, allocating capital. So, we know the types of investments, but how do these massive decisions actually move from, say, a quick pitch in a meeting room to a fully executed strategy? Well, it happens through a very rigorous 4-step capital allocation process. Step 1 is idea generation, pulling in concepts from internal managers or maybe external consultants. Step 2 is investment analysis. This relies heavily on highly granular proprietary non-public data to forecast future cash flows. Then we hit Step 3, planning and prioritization, which is all about ranking projects based on risk-adjusted returns and corporate strategy. And finally, Step 4 is monitoring. Crucially, though, corporate finance is not a straight line. It's a continuous cycle. That 4th step, monitoring, isn't just about checking a box. It's about validating past assumptions. Did that shiny new expansion actually generate the expected cash? By uncovering exactly where they were overly optimistic or pessimistic, management feeds better, highly refined data directly back into Step 1, idea generation, for the next wave of investments. It's a constant feedback loop. Section 3, the scorecard. Measuring value. To actually prioritize these projects, executives need a way to keep score. This is where we're going to do a little bit of heavy mathematical lifting, but don't worry, we'll keep it intuitive. The absolute heavyweight champion of these metrics is net present value, or NPV. In really simple terms, it estimates the absolute wealth increase for the firm in pure currency, like dollars or euros. It takes all those future expected after-tax cash flows, discounts them back to today's value to account for risk and time, and then subtracts the initial cost. So if the NPV is above 0, boom, the project creates wealth for the shareholders. The second essential tool is the internal rate of return, or IRR.
Now, while NPV gives you a hard dollar amount, IRR gives you a percentage. Specifically, it's the discount rate that makes the NPV of an investment exactly equal to zero. The decision rule here is pretty straightforward. Invest if the IRR exceeds the company's required rate of return, which we often call a hurdle rate. For instance, in our source material, Garhart Corporation was evaluating a €50 million project. The math revealed a really impressive IRR of 19.52%. And because that comfortably exceeded their 10% hurdle rate, the decision was a clear go.
So, here is the absolutely crucial point. What happens when NPV and IR disagree? Imagine you can only choose one project because they're mutually exclusive. Project A has a higher IRR, but Project B has a higher NPV. Which do you pick? The answer is always the project with the higher NPV. Why? Because investors take dollars to the bank, not percentages. NPV measures the absolute increase in wealth, which makes it the theoretically superior choice every single time.
The company-wide metric, analyzing ROIC.
Now, those previous scorecards, NPV and IRR, they are fantastic for internal use, but they rely on secret proprietary forecasts. Independent analysts looking from the outside, they have to use a company-wide metric called Return on Invested Capital, or ROIC. Let's look at an example from the source material where a company generated an ROIC of 8.73%. To figure out if this is actually good or bad, an analyst compares it to the investor's required rate of return. If investors require a 10% return, but the company is only generating 8.73% across its capital base, well, the company is actually destroying value, even if they are technically profitable. It essentially signals that investors could get better returns somewhere else for the exact same amount of risk. To understand how to fix a sluggish ROIC, you really have to unpack how it works under the hood. ROIC is driven by two main things: after-tax profit margins and capital turnover, which basically means how much in sales the invested capital generates. You can boost your ROIC by improving your margins or by generating sales faster on that same asset base. However, it is super important to remember its limitations. ROIC is an accounting measure, it's not pure cash flow, and it's strictly backward-looking. It tells you what happened, not necessarily what's going to happen next.
Section 4. The fumbles. Capital pitfalls.
So why do smart executives at massive companies still make terrible capital allocation decisions? Well, before we look at the fumbles, we have to know the rules. Executives must evaluate decisions based strictly on after-tax incremental cash flows. That means completely ignoring sunk costs. They also have to carefully account for the exact timing and volatility of the money. And crucially, this is a big one, they must look for real options. What are those? They're the built-in flexibility to alter the timing, the sizing, or even the fundamental approach of a project as market conditions change. Having those options can massively enhance an investment's value over time.
But of course, things do go wrong. And when they do, they generally fall into two buckets. The first are cognitive errors. These are just simple technical fumbles. Calculation mistakes, inconsistent treatment of inflation, or simply forgetting to account for internal financing costs. But the second, and honestly much more dangerous bucket, involves behavioral biases. These are psychological errors in judgment and deep institutional blind spots that absolutely plague real-world boardrooms. Perhaps the single greatest threat to corporate value is the pet project bias. This happens when a powerful executive fiercely champions a specific project, and suddenly all that rigorous analysis we talked about just goes right out the window. The team starts using overly optimistic projections to inflate the profitability, making a frankly terrible idea look like a total winner on paper. Combine this with corporate inertia, which is just spending money the exact same way you did last year because it's easier, and a fixation on short-term accounting measures instead of long-term cash flows, and you literally have a recipe for disaster. So, stepping back into the shoes of the CEO, your challenge is clear. The tools for creating immense shareholder value are right in front of you. Categorizing your growth initiatives, rigorously modeling the NPV, utilizing those real options, and constantly monitoring your overall ROIC. But at the end of the day, do you actually have the unyielding discipline to follow the cold hard math? Or will you let ego and bias trick you into funding the next great pet project? That is the true test of capital allocation. Thanks for joining me on this explainer, and remember, keep questioning the numbers.